How would you like an extra $500 deposited into your bank account every single month without working another hour and without touching your principal? That's $6,000 a year, enough to cover your rent, your car payment, your groceries, or a nice vacation every few months. And what if I told you that you could build this income stream starting with just $50, even if you have no investing experience, no rich uncle, and no gambling on crypto or meme stocks? If you stay until the end of this video, I'm going to give you the exact blueprint to build a $500 per month dividend portfolio from absolute scratch. I'll show you which stocks, ETFs, and REITs to buy, how much you need to invest, and the fastest way to get there, even on a tiny budget. You'll never have to rely on a paycheck alone again. My name is your name, and today we're building a money machine that pays you while you sleep. Let me start with a story that will change how you think about dividend investing. A viewer named Lisa was a single mom working as a cashier, making $28,000 a year. She had no savings and no investing knowledge. She started putting $20 a week, not $20 a day, $20 a week, into a dividend ETF. That's less than one fast food meal. 3 years later, she had $3,200 and was getting about $10 a month in dividends. Not much, but it was something. She kept going. After 7 years, she had $15,000 and was getting $50 a month. Then she got a small raise and increased her weekly investment to $50. 10 years from when she started, she had $45,000 and was getting $150 a month. She's now on track to hit $500 a month in dividends by year 15. She told me, "I never thought a cashier could own a piece of Coca-Cola, Procter & Gamble, and Realty Income. But I do, and every month they pay me for just breathing." That's the power of dividend investing. You don't need to be rich. You just need time, consistency, and the right strategy. And today, I'm giving you that strategy. Before we dive into the numbers, let's understand what dividend investing is. A dividend is a portion of a company's profit that it pays out to shareholders, usually every quarter. Some companies pay monthly. Think of it like this. You lend a friend $1 time to start a lemonade stand. The friend makes $200 profit and gives you $50 as your share. That $50 a dividend grows. Your $50 might become $60, $70, or more. And you never have to tell share, you just collect the cash. Now, how much money do you need to generate $500 per month in dividends? That depends entirely on the dividend yield. Yield is the annual dividend divided by the stock price. For example, if a stock costs $100 and pays $4 per year in dividends, its yield is 4%. At 4%, you need $150 operating to generate $500 per month, because the $150,000 times 4% equals $6,000 per year, divided by 12 months equals $500. At a 5% yield,
you need $120,000. At a 6% yield, you need $100,000.
At an 8% yield, you need $75,000. At a 10% yield, you need $60,000. So your target portfolio size depends on the yield you can safely earn. But here's the catch. Very high yields often come with very high risk. A stock that yields 10% might cut its dividend tomorrow or go bankrupt. You don't want that. So we're going to target a realistic, sustainable yield of 4% to 6% for the core of your portfolio, with a small portion in higher yield but still reasonably safe assets. That means you'll need between $100,000 and $150 Zuzen to generate $500 per month. That sounds like a lot, but I'm going to show you how to get there from zero, starting with as little as $50. Let me break down the 3 phases of building a $500 monthly dividend portfolio. Phase 1, the first $10,000, building the habit. In this phase, Your goal is not the income, it's the behavior. You're training yourself to invest consistently, ignore market noise, and reinvest every penny. At this stage, your monthly dividends might be $10, $20, or $50. That's fine. The magic happens when you reinvest those dividends to buy more shares, which then pay more dividends. It's compound interest in action. How do you get to $10,000? If you invest $50 per week, that's $2,600 per year. In about 3.5 years, you'll have $10,000 without any growth. With a 7% average return, you'll hit $10,000 in just over 3 years. If you invest $100 per week, you'll hit $10,000 in under 2 years. The key is automation. Set up a weekly transfer from your checking account to your brokerage account. Treat it like a bill. Even $20 a week adds up to over $1,000 a year. Most people can find $20 by skipping 1 restaurant meal or 2 coffees a week. Now, what to buy in phase 1? You want one simple, low-cost dividend ETF that gives you instant diversification. My top pick for beginners, the Schwab US Dividend Equity ETF, ticker SEHD. SEHD tracks 100 high-quality U.S. companies with a history of paying and growing dividends. Its expense ratio is 0.6%. As of 2026, its yield is around 3.5% to 4%. Other great options. Vanguard Dividend Appreciation ETF, VG, yield around 2% but very stable growth. And iShares Select Dividend ETF, DVY, yield around 4% but with slightly more risk. For pure simplicity, I recommend SEHD. Set up a recurring buy of $20, $50, or $100 per week into SEHD. Don't look at it, just let it run. Phase 2. The middle game, $10,000 to $50,000. Asterisk, at this stage, you're starting to see real dividends. With $50,000 at 4% yield, you're getting $2,000 per year, or about $167 per month. That's not $500 yet, but it's meaningful. Your goal now is to increase your yield slightly without taking on too much risk. You can do that by adding individual dividend stocks or REITs that pay higher yields than SEHD. Here's where I recommend you build a core and satellite portfolio. Keep 60% of your money in SEHD, that's your core. Put 20% into a high dividend REIT ETF like VNQ or a monthly dividend REIT like Realty Income, ticker O. Realty Income is known as the monthly dividend company because it pays dividends every month. Its yield in 2026 is around 5.5% to 6%. It has increased its dividend for over 30 consecutive years. That's reliable monthly income. Put another 10% into a utility ETF like XLU or a consumer staples ETF like XLP. These sectors are defensive. People need electricity, water, and toothpaste in recessions. Their yields are usually 3% to 4%. Put the final 10% into a higher yield but still respectable dividend stock like AT, Verizon, VZ. As of 2026, AT&T's yield is around 6% to 7%. But be careful, these companies have high debt and slower growth. Don't put too much here. At $50,000 with this mix, your average yield could be 4.5% to 5%. That's $2,250 to $2, $500 per year, about $190 to $210 per month. You're almost halfway to $500. Phase 3, the finish line, $50,000 to $150,000. This is where the magic happens. Your portfolio is large enough that your own dividend reinvestment starts accelerating the growth. At $100,000 with a 5% yield, you're at $5,000 per year, $417 per month. You're just $83 short of $500. That's an extra $1,000 per year in dividends. You can get there by adding a few higher yield investments or by continuing to contribute. To close the gap, I recommend adding a closed-end fund, CFF, that focuses on high-yield dividends. A CEF is like an ETF but with a fixed number of shares, often trading at a discount to its net asset value. Some CEFs yield 7% to 10%. Examples include the Eaton Vance Tax Managed Global Diversified Equity Income Fund, ticker EXG, yield around 8% as of 2026, or the Nuveen Dow 30 Dynamic Overwrite Fund, ticker DIAX, yield around 7%. These funds use option strategies to boost yield, but they come with higher fees and more complexity. Limit them to 10% of your portfolio. Alternatively, you can simply wait a few more years. If you have $100,000 at 5% yield and you continue to add $200 per month, with 5% growth and reinvested dividends, you'll hit $500 per month in about 2 to 3 years without changing anything. That's the beauty of patience. Now, let me give you specific examples of dividend stocks and ETFs with their realistic yields for 2026. Hi, so you don't have to. Dividend ETFs. Core Holdings, SEHD. Yield 3.06%, monthly or quarterly. Quarterly. Yield 2.02%, expense ratio 0.06%. Very stable dividend growers. VYM, Vanguard High Dividend Yield. Yield 3.03.5%. Expense ratio, monthly dividend REITs and stocks Realty Income, yield 5.560%. Monthly payments, 30 plus years of increases. STAG, Industrial, STAG yield 4.05%. Monthly industrial warehouses. Main Street Capital, yield 6. Development 7%, monthly but higher risk. Gladstone Investment, yield 6.7%. Monthly, also higher risk. Tashkuft quarterly but large yields. AT&T yield 6.7%, but check debt levels. Verizon VZ yield 6.7%. Altria MO Tobacco Company yield 8.9%, very controversial but high cash flow. Enbridge Canadian Pipeline Company yield 7.8%. Dividend REIT ETFs VNQ yield 4.5%. Diversified real estate. Schwab REIT ETF, similar yield. Oster International Dividend ETFs. VXUS International Total Stock has lower yield, around 3%. But consider VYMI, Vanguard International High Dividend yield around 4.55%. Now, a word of caution, high yield often means high risk. A stock yielding 10% might be in trouble. The price may have fallen because investors expect a dividend cut. Always check the payout ratio. If a company pays out more than 80 to 90% of its earnings as dividends, it may not be sustainable. For REITs, the payout ratio is measured differently. They must pay 90% of taxable income, but still check funds from operations, FFO. A healthy REIT has an FFO payout ratio below 80%. Let me give you a realistic $500 per month portfolio example with real numbers. Assume you have $120,000 invested as follows. $60,000 in SEHD, yield 3.8 pure dollars per year. $30,000 in O, Realty Income, yield 5.8 $17,040 per year. $15,000, yield 4. $2,000 in fee, AT&T, yield 6.5 dollars, 6 dollars, 2 dollars in Yelix Buddy 2,000 Fed, $1,040 Fisher dollars 2,040, total annual 40, plus 6 or 30, plus 625, 5,006, divide by 12, $468.75 per month, close to $500. Add a little more to any position, or add a small monthly contribution, and you're there. Now, how do you build this from scratch with only $50 to start? Here's the step-by-step weekly plan. Week 1. Open a brokerage account at a commission-free broker like Fidelity, Schwab, or Vanguard. Deposit $50. Buy 1 share of SEHD. It trades around 70-80, so you might need to buy a fractional share. Most brokers allow that. Set up a recurring weekly purchase of $10, $20, or $50. Start with what you can. Month 1-6, keep buying SEHD only. Don't complicate it. Reinvest dividends automatically. Turn on DRIP dividend reinvestment plan. After 6 months, you might have $500 to $1,000. Good. Month 7-12. Start buying realty income, O, with a portion of your weekly contribution, say 50% SAHD, 50% O. O trades around 50-60, so fractional shares make it easy. Year 2, add VNQ or a utility ETF like XLU. Keep the 60-20-20 split. By the end of year 2, if you're investing $50 per week, you'll have about $5,200 plus growth, maybe $6,000. Your monthly dividends might be $20. That's small, but you're on the path. Year 3-5. Asterisk. Increase your weekly contribution as your income grows. Every time you get a raise, add half of the raise to your investment. If you can get to $100 per week, you'll hit $15. Use them by year 3, $30,000 by year 5. Dividends, $100 per month at year, $200 per month at year 5. Asterisk, year 6 to 10, now you're in the middle game. Continue adding, and your dividends will compound. At year 10, with $100 per week and 7% average return, you'll have about $80,000. At a 4.5% yield, that's $300 per month. You're over halfway. Asterisk, year 11-15. Asterisk, the final push. At year 15, with the same $100 per week and 7% return, you'll have about $170,000. At a 4.5% yield, that's $638 per month. You've surpassed $500, and you did it with just $100 a week, the price of 2 dinners out. But what if you can't do $100 a week? What if you only have $20 a week? At $20 per week, after 15 years at 7%, you'll have about $34,000. At 5% yield, that's $1,700 per year, $142 per month. Not $500, but still meaningful. And if you keep going to 25 years, $20 per week becomes $70, $0, and $292 per month. Add Social Security and a paid-off house, and you're comfortable. The key is to start. Even $10 a week is better than 0. Now, let me address the most common mistake: chasing yield. I see people put all their money into a single high-yield stock like AT&T, only to see the dividend cut or the price crash. Don't do that. Diversify across sectors, companies, and asset types. Use ETFs for your core, individual stocks for your satellites. Never let any single dividend payer be more than 5–10% of your portfolio. That way, if one fails, you don't lose your income stream. Another mistake: ignoring dividend growth. A stock that yields 3% but grows its dividend by 10% per year is often better than a stock that yields 6% with no growth, because after 10 years, the growing dividend will be much higher. Look at the dividend growth rate. Companies like Johnson & Johnson, Procter & Gamble, and Coca-Cola have increased dividends for 50+ years. Their yields are only 2 to 3% today, but their dividend growth is 5 to 6% per year. Over time, your yield on cost, the dividend divided by what you originally paid, becomes enormous. I own shares of a consumer staples ETF that I bought 10 years ago. My yield on cost is now over 8%. That's the magic of dividend growth. So here's a hybrid strategy. Put 50% into SEHD for a mix of yield and growth. Put 30% into dividend growth stocks like VIG or individual stocks like J&J, PG, KO. Put 20% into higher yield REITs like O and maybe a utility fund. That portfolio will give you decent current income plus growing income over time. Now, let's talk about taxes. Dividends are taxable in the year you receive them. Qualified dividends from most U.S. stocks held for over 60 days are taxed at the lower capital gains rate, which is 0%, 15%, or 20% depending on your income. Non-qualified dividends from REITs, some foreign stocks, etc., are taxed as ordinary income. So for high earners, REIT dividends are less tax efficient. The solution? Hold your REITs in a Roth IRA. There, all dividends grow tax-free and can be withdrawn tax-free. I covered this in Script 6. If you're building a dividend portfolio in a taxable account, focus on qualified dividend payers. If you're using a Roth IRA, REITs are fantastic. Let me give you a real story of someone who built a $500 monthly dividend portfolio. A viewer named David was a truck driver earning $60,000 a year. He started at age 35 with $50 a week. He used SEHD and O. He never missed a week. At age 50, he had $120,000 and was getting $450 a month. He added a few more high-yield shares and hit $500 at age 52. He told me, "I still drive my truck, but now I know that every month, without fail, an extra $500 shows up. That's my vacation fund, my car repair fund, my peace of mind." David didn't get rich overnight. He got rich slowly, and that's the only way that works now. What about using DRIP, dividend reinvestment? In the accumulation phase, always turn on DRIP. That means your dividends buy more shares automatically, which then pay more dividends. It's the closest thing to a perpetual motion machine in finance. Some brokers let you buy fractional shares, so DRIP works even with small dividends. Turn it on today. One more tool, dividend tracking apps. Use an app like Dividend Tracker, The Rich, or even a simple spreadsheet. Seeing your monthly dividend number grow is incredibly motivating. I check mine once a month. It's like a video game where the score only goes up now. Here's your step-by-step action plan for the next 24 hours. Step 1. Open a brokerage account if you don't have one. Use Fidelity, Schwab, or Vanguard. All offer fractional shares and DRIP. Do it now. It takes 10 minutes. Deposit $50. Use a linked bank account. Step 3. Buy a fractional share of SEHD. If your broker doesn't do fractional shares, most do now, buy one full share if you have enough, or buy a similar ETF with a lower price like SPHD, which is around $40–45, yield 4–5. But SEHD is better. Step 4. Set up a recurring weekly investment of whatever you can afford. $10, $20, $50. Start small. The habit matters more than the amount. Step 5. Turn on DRIP for your account. This is usually a setting in the account preferences. Step 6. Add a calendar reminder for 6 months from now to review your portfolio and consider adding a second holding like Step 7. Comment below. My first dividend goal is KMI per month. Fill in the blank. Mine was $100. Now I'm at $500. You can do it too. If this video gave you the roadmap to passive income, hit the like button. It helps others discover that they don't need to be rich to start building wealth. Subscribe and turn on notifications. In the next video, I'll be doing a live Q&A answering your questions from all 15 scripts. Bring your toughest questions about retirement, taxes, credit cards, and real estate. Dividend investing isn't sexy. It's not crypto pumps or meme stock moonshots, but it works. It has worked for decades, and it will work for you. Every dollar you invest today is a soldier in your army of passive income. Send them out, let them work, and one day you'll wake up to $500 in your account that you didn't have to lift a finger for. That's financial freedom. Now go start. I'll see you in the next video.